Welcome back to the Infinite Income Podcast. I'm Autumn Bennett.
And I'm George Mayfield, also known as the Dividend Doctor. We've got a powerful episode for you today. If you're a dividend investor, you definitely don't want to miss this.
That's right. Today we're diving into why FDVV, the Fidelity High Dividend ETF, is absolutely crushing SCHD in 2025 and what that means for your portfolio. Is FDVV the new dividend king? We're breaking it all down.
Over the past year, I've been analyzing a wide range of ETFs, from those that chase growth to the steady dividend pairs, and along the way, I've spotlighted funds that looked ready to outperform, and I've waved a few red flags too.
One of those red flags, George, was for SCHD, right?
Yep. About 3 months ago, I issued a pretty direct warning to dividend investors about SCHD. I saw some specific market dynamics shaping up that I believe could really put pressure on its performance heading into 2025.
And unfortunately, you were right. Since then, SCHD has underperformed most of its peers.
Big time. The issue? Sector exposure. SCHD's allocation just hasn't lined up well with what's happening in today's economy. We're seeing things like rising tariffs, softening oil prices, and some macro shifts that are really dragging on the sectors that SCHD leans into heavily.
But George, you didn't just warn investors, you offered some alternatives too, didn't you?
Absolutely. One of the ETFs I highlighted back then wasn't just a solid option, it's been a standout. It's FDVV, the Fidelity High Dividend ETF. Not only has it outperformed SCHD, it has beaten the S&P 500 recently.
That's huge. And considering where interest rates seem to be headed, FDVV might be the best positioned passive dividend ETF on the market right now.
That's the key, how it's built. It all comes down to sector allocation, stock selection, and the strategy behind the fund.
You gave FDVV a buy rating 8 months ago, right?
I did. Then, after the market hit a low in April, I doubled down on that call. And since then, FDVV has outpaced SCHD by almost 10%.
That kind of outperformance can make a big difference over time, especially for dividend-focused investors.
Absolutely. FDVV has managed to deliver not just strong capital appreciation, but also solid downside protection. In the last 3 years alone, it's returned nearly 60%. Compare that to SCHD's 24%. Over 5 years, FDVV is up 120%, while SCHD sits at about 80%.
And it's not just about growth. FDVV has kept its dividend yield above 3% while managing risk. In the 2022 bear market, for instance, FDVV only dropped 5%, which is right in line with SCHD. That's impressive.
And it held up well again during the sell-off back in February 2025. Its consistent performance is one reason its assets have nearly doubled since I first reviewed it.
And Morningstar has noticed, too. FDVV currently holds a 5-star rating, while SCHD has dropped to 3 stars.
Exactly. So let's get into what makes FDVV tick and why it might continue to outperform in today's market environment, especially with interest rate cuts looming.
First off, FDVV launched in September 2016, which means it's got nearly a decade of historical performance to study. Right now, it's managing just under $6 billion in assets, with an expense ratio of 0.15%.
Slightly higher than SCHD, sure, but still very affordable, especially when you consider its strong performance.
Now, here's where things get interesting. FDVV's sector allocation. It's diversified. Tech leads the way with about 25%, followed by financials at around 20%, and then a nice mix of consumer defensives, real estate, energy, and utilities. This blend captures growth potential, tech, while also offering defensive stability with utilities and REITs.
That blend is powerful. You get the growth engine of tech, but you also have strong income and risk management from sectors like utilities and real estate.
Over 20% of the fund is allocated to real estate, utilities, and consumer defensives, sectors known for their income and stability.
And that's a huge reason why FDVV has held up so well, even during market downturns. Plus, when you look at its top 10 holdings, you'll see names like Apple, Microsoft, and Nvidia together making up 14% of the portfolio. That tech exposure helps provide strong total return potential and growing dividend payouts. And FDVV's allocation to REITs and utilities could benefit significantly from interest rate cuts, making it potentially better suited for the current economic environment.
All good points. Wait a minute. Those tech companies aren't in SCHD, are they?
Nope. SCHD doesn't include them. That's a big differentiator. These are companies with strong dividend growth and massive capital appreciation potential.
So how does FDVV balance these growth giants with income-focused sectors?
It all comes down to 3 screening criteria: dividend yield, dividend payout ratio, and dividend growth, specifically trailing 12-month growth.
And dividend yield carries the most weight, 70%, right?
Correct. That's why FDVV includes high-yield sectors like REITs and utilities. But here's where it gets timely: rate cuts. With the Fed likely to lower rates, these sectors could benefit big.
Right. Rate cuts reduce borrowing costs, boost real estate development, and drive demand. So FDVV's real estate allocation could be a major tailwind.
And it doesn't stop there. Utilities and consumer defensive stocks get more attractive when rates fall because investors start hunting for income beyond bonds.
FDVV also screens for dividend payout ratio, but avoids the top 5% to steer clear of companies that might not be able to sustain those payouts.
Smart move. It helps filter out yield traps, those companies that pay big dividends but are weak underneath.
And then there's the 12-month dividend growth screen. That's different from ETFs like SCHD, which require multiple years of dividend growth history.
Exactly. FDVV's shorter window allows it to include strong companies that recently started paying dividends, like Microsoft, Apple, and Nvidia.
So you get both upside potential and steady income. That's a rare combo.
It really is. FDVV blends tech momentum with dividend stability, something few ETFs can pull off without adding volatility.
But let's be fair. No ETF is perfect. What's the catch?
The main drawback is that 12-month dividend growth doesn't show long-term consistency. That's where SCHD still has an edge. It filters for companies with 3 to 5 years of steady growth, which gives you more predictability. With an inception date of 2011, SCHD has a longer performance history and a strong reputation among dividend-focused investors. SCHD doesn't chase momentum or rotate aggressively. Its simplicity and low turnover are appealing, especially for retirees who want steady, predictable income.
So if you're focused strictly on building a rising dividend income stream year after year, that might give you pause.
Exactly. But for total return investors who want a balance of yield, growth, and risk control, FDVV is extremely compelling, especially in today's climate. Or you might consider holding both in a 60-40 or 50-50 mix, using SCHD as the steady income anchor and FDVV as a growth-enhanced dividend complement.
We'll be keeping a close eye on this one, and in our next episode, we're walking you through how to build a retirement portfolio using a more strategic, results-driven approach, not just the typical growth versus value model.
That's right, we're going deeper. So if you haven't yet, make sure to subscribe and tap that follow button.
And hey, if this episode helped you, share it with a fellow investor or leave us a review. It really helps the show grow.
Thanks for listening to the Infinite Income Podcast. I'm George Mayfield.
And I'm Autumn Bennett. Until next time, invest wisely and keep building that infinite income.